Hello everyone and welcome back to another Conquer FX YouTube video. Today we're going to be talking about the core components of any trading strategy. Now, although this looks like a blueprint for creating your first trading plan, this video is actually more tailored to people who have a basic trading plan but haven't really got the results they're looking for yet. So the whole point of this video is to basically provide more clarity behind what you're doing, because when we provide more clarity, we're going to increase your trading performance automatically, because first of all, you understand the expectations of what your trading plan should deliver through collecting data. And we're also going to be able to remove as much psychological friction as possible. Because here's the thing, and this is where I usually lose a lot of people, but because they don't have clarity, they think their problems are with trading psychology. But if you do not have clarity behind what you're looking for, you realistically do not have a trading psychology issue. You're realistically having a problem with a lack of clarity, or you're having a problem that you do not have the correct expectations of what your strategy can deliver. Why? Because you do not have clarity behind how your strategy works. Now, the way I usually explain this is in the 7 pillars. Now, I believe the 7 pillars were mentioned here in another graph, in another video, somewhere over here. Yes, when we were talking about the solution for anxiety. Now we're going to be breaking this down in the YouTube video very soon. You can find all this information on my Instagram. We're also talking about how wise men store up knowledge and how to go about that, how to make better trading decisions. And the great thing about this is I'm going to be bringing out a resource very soon with all of these breakdowns in a lot more detail, in a more kind of simplified, bulletproof approach, so you can always keep up to date to make sure that you're following these exact flowcharts that have been proven to work over and over again by my success and by my students' success. Here is the characteristics of successful traders. We already broke that down, and also about, should we let our winners run? So you can find all those videos on my YouTube channel. Also, if you have liked the video so far, I would really appreciate if you like, comment, and subscribe. I'd really appreciate that. Now, we're going to just jump straight into this here, okay? Now, when it comes to trading plans, we need to get rid of some, trading myths first of all, okay? The first myth being that consistently profitable means that you're going to consistently win over and over again and never lose. That is not the reality. The reality is that your equity curves are going to look something similar, maybe even worse to this, and also your trading plan does not have to focus simply around your risk reward. Once again, there's 2 things I see people focusing on all the time. They pay the most attention to their entries and they pay most attention to their risk reward, instead of actually trading the market and bringing clarity and strengthening all the 7 pillars of their trading plan. And I'm going to explain this analogy now in 1 second. Right, so let's talk about the 7 pillars and why it's so important. First of all, just before we jump into the 7 pillars and explain why we shouldn't just be focusing on entries and risk reward, which you probably already know, but it's just because it's so fancy, people tend to gravitate towards it more. But these are the 7 pillars. The 7 pillars are the core components of any trading strategy. So if you were to look at any successful trading strategy as a whole, it would have these 7 components evident, and then you could basically add on additional confirmations, which would make it 9. So, let me get straight into this. First pillar is entry, then it's exit, time, price positioning, risk management, trade management. They're your 7 pillars, and your additional confirmations are going to be things like your macro and fundamental view or overall trading sentiment. Now, the reason why we can't just focus on 1 pillar is because the rest will crumble, and this is why I call them 7 pillars. If we come down here and we'll just do a small little drawings for a second, I want you to imagine that there are 7 pillars, okay? So let me just bring this up here. I want you to imagine that there's 7 pillars. So we've 1, we've 2, 3, 4, 5, 6, 7, okay? And I want you to imagine that this is your entry, your exit, your time, your price positioning, your trade management, your risk management, all the core components. Now, let's just imagine that this was a structure, because as we said, this is the 7 pillars, okay? It's a structure, and I want you to imagine that it's holding up a roof like this. Now, think about it. Just like a trader spends a lot of attention on their entries and risk reward, if we were, let's just say this is your entry here, if we were to only pay attention to the first three things: the entry, the exit, and the timing. Let's say we're building a structure and we build these pillars really, really strong. We spend a lot of time around the planning, and we're basically just obsessed with strengthening these pillars. What would happen when there's a storm? What would happen when, the entire structure is built and people start to move in, or there is some sort of weather warning or something else? What's going to happen to the structure? When it's on its sunny days, it's going to hold. But when it's put on under any stress, these other four pillars that we never paid attention to are going to collapse. And because these four pillars fall due to a lack of attention and detail, the entire structure is going to fall. And therefore, we're not going to have a strong structure anymore. It is the exact same for your trading plan. You need to stop paying so much attention to optimizing one area and make sure that each pillar of your trading strategy has data to back up exactly why you're doing it. So for example, your entry, what is your entry criteria? I just want to use basic examples to really hit at home at how important this is. Let's say you're stuck between using a simple pattern between your pin bar and engulfing. First of all, mark up on your charts what your trading setup looks like. First of all, see the amount of times this has actually come up, which is more common, a pin bar or an engulfing candle. Then see, okay, well, what is the probability that this engulfing candle is going to move for X amount of pips? Or what is the probability that this engulfing candle is going to move 1 times its range, and then I can move to break even after it moves 1 times its range? All right, we want to do that for your pin bar, your engulfing candle, and then we want to carry out a comparison analysis. This is how we find out why we do one thing over another. So for example, if I said to you, why do you enter that way? And you turn around to me and say, I just prefer to do that. That is a hunch. That is an emotional decision, some sort of emotional attachment that you have because it resonates with you. But unfortunately, that doesn't mean that it's going to be successful. It's like if we think of emotional decisions overall, when it comes to people who have trading plans and pay too much attention to entry or exit, etc., just like I explained there, if they're making emotional decisions with everything else, their trading strategy is not going to provide consistent results. Why? Because if you do not feel the same way as you did today, as you did before and the day before that, and your emotions are looking like a roller coaster, and you're making decisions off your emotions, your results are going to look the same, and your equity curve is going to portray your emotional, basically your lack of emotional knowledge or capability to actually make decisions off a consistent, repeatable approach. So like I said, you want to take your entry, you want to pick 2 things, you want to come up with a hypothesis and test them and understand, why am I entering this way over this way? The same with your exits. You want to come up with different criteria. Am I going to hold it to take profit? Well, then you want to start asking questions like we did here about, should you let your winners run? How far do you let it run if so? What metrics can you use to keep it consistent? Can we target 3 times ATR? Can we target the following weekly high? Or maybe we'll trail our stop once we reach there. Will we trade that and hold our trades during the news? All of these different things are important for your exit, which will also fall in under trade management in a way. Then we want to talk about time. Timing can be on a broader scale or a micro scale. So for example, when it comes to trading sessions, a lot of the time you want to dive into one particular session. One thing that we talk about in my mentorship program is how people do not use their session timings to their advantage. Looking at previous sessions and how they opened up, how they closed, the reactions they had, the price delivery to certain levels, tells us a lot for the up and coming session. Just like how Asian session provides a lot of information for how you might want to trade London, Asia and London with their placement will provide you a lot of information for how you want to trade New York. Obviously, when we add in the additional confirmations like the sentiment and the macro and fundamental view. Now, when it comes to timing, we can also look at it as a broader scale. So for example, seasonal trends will be considered timing because on average, let's say we see the euro increase, on average over the last 10 years in December. Well, that would be a seasonal prediction. That would be down to timing. So, the timing is right now to look for longs on euro from a seasonal point of view. Okay, so that's another way of looking at time, kind of on a broader scale, but we can still use it, and that can still add into the timing pillar, even on a much broader, longer term scale. Even from a scalping point of view, you know, the 9:30 New York Eastern time is known that when we're at the higher low of the day, it provides some amazing reversal opportunities. Or if we're in a trending market and then we're in a pullback at 9:30 New York Eastern time, there's a very high probability that you're going to see some sort of a continuational setup there to be able to profit from. The next thing is price. You know, what's your point of interest? Where is that going to be positioned? You know, for example, if you use quarter theory, that would be an example of the price levels you want to trade at. You only want to trade at the price levels that are lining up with quarter theory. The next thing would be price positioning. One of the most underrated things there possibly is actually price positioning in my personal opinion, alongside time. So a lot of people don't pay enough attention to timing and the sessions and their placements, and they don't truly understand the details of timings, even down to 4-hour candle flips and everything else. But price positioning is also something I really don't hear people talking about. So for example, price positioning can allow you to eliminate a lot of the noise and provide extra clarity for what you're looking for. So for this current month of July, I've had 2 trades, that's all. But before I even got a trade set up, I was sitting on my hand for 17 days and I would be considered an intraday trader. I was putting up on Twitter and people were saying, man, you know, you're missing out on opportunities. These are clear trending markets and all this other bullshit where people were trying to basically tell me that they knew my edge better than I do. But what I was able to do was I was allowed to cut out all the noise because it wasn't setting up in the positioning that I wanted it to be at, where we're basically forming this very, very particular pattern around the weekly high or weekly low, or previous daily highs and lows, or consecutive days in the bullish market team. You know, my students will understand what I'm talking about here, but I'm very, very focused on the price positioning, because if I'm not in the positioning, or if the market is not in the positioning where I want it to be, there is no trade trigger. So for example, your price positioning might be a 70% pullback after an initial high and low is created for your Fibonacci retracement. It could be that I only want to look for reversals when I'm at the higher low of the day. Another very profitable approach for cutting out the noise. Because if you look, where are the biggest moves taking place? They're taking place at the higher low at the everyday chart. You have your initial high and low set in the first 8 hours of every single day. And then we usually have shifting behavior on either side of that on shifting days or ranging days. And then on trending days, we usually have a shift below for a further move up or whatever else. Okay, so that is price positioning as a whole. Then it's risk management. Will you design different risk models? What sort of risk reward will you use and everything else? Now, here's another trading myth. They tell you to risk 1% per trade, but what if that doesn't fit in your risk tolerance? For example, I often use the example here of understanding your sweet spot. So your sweet spot is this area here. And outside the sweet spot, you have your extremes. And what you need to understand is that this area here is when you risk too little. This area here is when you risk too much. And this area here is your sweet spot. Now, when you come into trading, people tell you to risk 1% straight away. And they say it as if it's a fixed way of doing things. And when you're in the trading world for long enough, you'll realize that there is no fixed approach to anything, because everyone's risk tolerance is slightly different. So especially when it comes to risk management, why would we give someone a fixed approach of doing something? In fact, you should spend around 1 to 2 to 3 weeks trying out different areas of risk, really playing around that 0.2% to 2% model. I wouldn't really go over 2% personally, and figure out what is your actual risk tolerance that allows you to execute with clarity. Don't just lean on the 2% because it might provide you with better results. In fact, moving down to 0.5% might actually allow you to execute without hesitation, actually providing better results than risking more. So this is the thing. When you find your sweet spot, it's going to allow you to execute without hesitation. And this is what it might look like. So the characteristics of a trader who is risking too much is hesitating. He has fear when they're in the trade, and usually a lot of anxiety is present. The trader who is risking too little doesn't really care about the outcome. A lot of the time they're saying things like, well, you know, my last trade was a winner, so I can risk, 0.2% on this just for the sake of getting into the trade. So they're trading it, but they don't necessarily care about the risk because it's so little. The trader who is risking just the right amount and is playing within their sweet spot is someone that doesn't necessarily think too much about executing or hesitating. They're comfortable with accepting the risk, but they still care enough about the consequences to follow their rules. So when you're able to find this area here, that is your ideal sweet spot. That is where you should continue to trade in until you can scale. And that is where we talk about psychological issues then, because people will often say like, oh, you want to have some sort of psychology coach or some sort of psychology course, etc. In my opinion, everything in psychology, and I'll make a video about this, is linked to a lack of clarity or the wrong expectations. You really should not have a psychological issue if you're coming into this game. Well, you shouldn't have a psychological issue unless you're coming into this game with trauma around taking risk or new opportunity or something like that, or if you're trying to scale your trading business. They're the two areas where we usually see in the real world, trading psychology issues. But if you're coming in and you're just learning the game, realistically, you just never had enough clarity behind what you were doing. Therefore, you were never taught correctly, and therefore you lacked the correct expectations. So find a mentor that can help you. And if you're looking for one, you can join our mentorship. Next, trade management. Trade management. So how will you manage the trade? Will you manage it and hold it to a 20 EMA? Will you manage it and hold it to the take profit? If it hits take profit, will you actually take some profits and continue to let that run? Will you move to break even? And make sure to understand, we spoke about this here the other day, that there is, where is this? It's somewhere here, maybe it's up here. Yes, there is no such thing as a risk-free trade. Stop moving to break even because you feel uncomfortable. That does not pay the bills. What pays the bills is moving to break even only if you have a reason to do so based off the data. And this is the problem. People are making decisions because they feel uncomfortable. They're making emotional decisions. And just like I said, if you're constantly making emotional decisions and you do not feel the way you did today as the day before that and the day before that, just like your emotions are inconsistent, so will your results. And that will show in your equity curve. So start developing clarity with this blueprint and start asking yourself, do I have clarity around any of these 7 pillars? What am I lacking in? What am I paying too much attention to? What are those sides of the structure that I need to strengthen? And then we can talk about the macro and fundamental view, having a basic understanding of what is driving the market on a particular day, what is priced into the market, and if something is priced in, what should we expect on a particular day? So if we're coming into FOMC, why are we seeing the dollar pump? What are the expectations or the probability of a further rate hike coming? And how will that market react coming into those days up to FOMC? Things like this. What does it mean for unemployment rates? What does it mean for further interest rate hikes? What does it mean if the CPI data has come in lower than expected, just like we've seen, just has come in lower, just like we've seen with the dollar, or just like the pound, literally 2 days ago, where we saw the pound CPI coming down really, really low, and we're seeing that not really, really low, but lower than expected, and we saw the market react to that very emotionally to that headline, even though it's very clear that we will see some further rate hikes to come. And then we've sentiment. So sentiment can be a very broad term, but we can just talk about trading sentiment as a whole. Are you going to trade against the majority, etc.? That can also be used as an additional confirmation. And just to jump back to trading management as well, just to make sure that you're also having the correct expectations. Realize that you do not need to win every single trade. If you're trying to build a strategy and you're trying to fix it so much to the historical data, you're not leaving enough flexibility and room to deal with the new information that you'll be executing on a day-to-day basis. If you're trying to fix your trading strategy to your backtested results for historical data and not leaving enough flexibility for live results, you're going to have a problem, and you're basically going to see this really, really clean equity curve in your backtesting, which is going to break when you move to live results. So when you look here at the win rate, here's a 2-to-1 risk reward. And with only a 50% win rate, you can more than make money. You can really, really bring home some great profits. Here's a 40% win rate with a 3-to-1 risk reward. 20 different samples. So you can imagine that this is 20 different traders' equity curves. As you can see here, we're still bringing home money. And once again, with a 65% win rate, this can even come down lower, and you'll see some certain sample sizes continuing to make money. With a 1-to-1 risk reward, we can clearly see that all of 20 sample sizes are still making money. And like I said, when it comes to risk reward, it is not everything. Stop trading your risk reward and start trading the market. develop a consistent, repeatable approach that allows you to execute on a day-to-day basis with clarity. Stop worrying about this, stop worrying about your entries, strengthen all the 7 pillars. Because, you know, the higher the risk reward you're looking for, the lower probability of winning per trade. So you need to realize that. And a lot of people don't talk. They say, oh yeah, well, you know, I'm going to aim for 1 to 10 or 10 to 1 or whatever. But they don't realize that, okay, well, your win rate might be like 20%. And that means that you're going to have a lot of psychological friction there when you're going through these losing streaks that you call them, when it's really just the edge that you've chosen to play out. It's like flipping a coin. There's only 2 outcomes here, heads or tails. And every time you flip, you get the outcome pretty instantly, and that will just shift between 2 to 1. But when it's 10 to 1, you're going to have to go through multiple losses of flipping that coin before you get that home run. And the further you try to take that in terms of the amount of capital you're trading, the harder it becomes to scale from a psychological point of view. And that's why you'll see a lot of people just trading 2 to 1, 3 to 1, trading the market rather than their risk reward, because they're more focused on actually scaling their trading business than trying to have a home run for Twitter's sake and to look cool in front of your friends, because for some reason all of these people need this validation from others instead of just treating this business the way it is. So yeah, overall guys, this is the video for today. If you have enjoyed this, I'd really appreciate if you could just like and subscribe and comment and tell your friends. Also, don't forget to check out the other videos. We spoke about, you know, should you let your winners run? And I spoke about this in a lot of detail. We also talked about the characteristics of successful traders. And if you did watch that video, make sure you're making a conscious effort to really break down these 7 characteristics and ask yourself, just like the 7 pillars, you know, what am I lacking in? What are the things that I need to start bringing up? Okay, I may have the self-awareness, but do I have the logic and critical thinking? Do I have the planning? Like, am I planning my trades ahead, and am I sticking to that plan? Am I a problem solver? Have I chosen or even tried to become better? I'm also going to be, I haven't done this video yet, but I am going to be breaking this down. If I was to start again, this would be my plan. Basically about how I would start accumulating different cash and how I would use the prop firms, and then how I would get outside capital. So I'm going to break that down as well in the future. So yeah, overall guys, this is the video for today. Please like, comment, subscribe, and I'll see you in the next one.